Welcome, everyone, to Freddie Mac's Policy on Point webinar series. My name is Chris Rasnick, and I'm a communications professional in single-family seller engagement. Here with me today are Gwen Zaxby and Jarrell Cohen. In a few moments, you'll get a chance to meet them and hear about their topics. In today's session, we'll be discussing the details of the performing loan repurchase alternative, the benefits of participation, and how to opt into the program. We'll also learn about some additional considerations to be mindful of. Now let's meet the team.
Thanks, Chris. My name is Gwen Saxby, and I am a single-family underwriting director supporting the rollout of the Performing Loan Repurchase Alternative Pilot. In addition to supporting this pilot, my areas of responsibility include training for our QC underwriters, QC technology, and QC policy and procedure. I've been with Freddie Mac for about 11 years now, beginning my work in loan product advisor and the asset and income modeler development, moving on to customer experience, and now I am in quality control. Before joining Freddie Mac, I worked in originations and operations in the retail space, and I graduated from Villanova University and New York Law School. Jarrell, do you want to come on and introduce yourself?
For sure, thanks, Gwen. So my name is Jarrell Cohen. I'm a senior manager in QC and operational risk over here in Freddie Mac's single-family acquisitions division. I primarily support the planning, development, and execution of some of our larger scale projects in QC. I've been with Freddie Mac for about 6 years, split pretty evenly between single-family acquisitions and enterprise operations and technology. Before Freddie Mac, I started my career in management consulting after graduating from the University of Virginia. So I'm excited about this pilot, looking forward to walking through it with you all today. I'll kick it back over to Gwen to start us off.
Thanks, Jarrell. I think Jarrell and I are both really excited to be able to speak with you today about this exciting innovation in quality control. And when I first learned about it, like many of you, I thought, this is too good to be true. What's the catch? And that's why I'm so excited to be able to present this pilot to you today, because it really is a terrific program. There is no catch. It really is true. Next slide. So we created a QC Council a few years ago to help us deeply understand the challenges that our customers face. And it's our goal to be the GSE of choice. And we know that in order to be this, we have to be easy to do business with. We learned through the council that performing loan repurchases can create operational and economic challenges for sellers. We learned that sellers often have to sell these loans on the scratch and dent market, resulting in significant losses to them. Historically, loan repurchase has been the primary remedy for loans with significant defects, regardless of whether the loan was performing. The Performing Loan Repurchase Alternative Pilot addresses this scenario. Sellers who participate in the pilot will no longer be required to repurchase most performing loans with significant defects. The purpose of this pilot is to incentivize loan quality. Freddie Mac is partnering with sellers to ensure the creation of quality loans. This pilot helps sellers while at the same time helping us manage our risk. We began this pilot with a small group of sellers at the end of last year, and we took what we learned and we're ready to offer this pilot more broadly to all of you. We found that the pilot is more efficient for sellers and for Freddie Mac. Pilot sellers still retain all the rights to appeal defect findings, just like they do today, and the rep and warrant framework is unaffected. Most importantly, this pilot rewards high-quality loan delivery. Jarrell, do you want to walk us through the details of the program?
Yeah, will do. So we can go to a couple slides here. One more slide as well. Thank you. So as Gwen mentioned, at the highest level, participating sellers will no longer be required to repurchase most performing loans. Larger sellers may still be required to pay a fee each quarter, depending on the QC results for that quarter. Smaller sellers will have no fee, but sellers of all sizes will get the benefits of this program. So under the old system, if Freddie Mac found a performing loan defect, sellers will be required to repurchase that loan or accept a different repurchase alternative, such as a recourse fee. So under this new system, our pilot does not change the standard QC process, but what it does is introduce a new alternative once a defect is identified. So to go step by step here, Freddie Mac QC will still look at loans just as they do today. If they find a significant defect, sellers will still receive a remedy letter from QC. That letter will still explain what the defect is and indicate whether or not that defect is included in the program. Sellers, as Gwen mentioned, still retain all appeal rights all the way up through impasse, regardless of whether or not that loan is included in the program. So if the loan is included, Freddie Mac will keep that loan, and for small sellers, that completes the process. For larger sellers, once the PL base sample is complete, Freddie Mac will calculate a fee for that quarter, and that fee will be leveraged on the next ACH sweep. So I'll talk more about that fee in a few minutes. For all sellers, so long as that loan continues to perform per the terms of the rep and warrant framework, Freddie Mac will retain those loans. So we can go to the next slide. So some details on the fee. So first things first, as I mentioned, only our larger sellers are subject to a fee. This determination is internal to Freddie Mac, but it's based primarily on recent quality and loan delivery volume. So the overwhelming majority of our sellers are smaller in nature. So what this means is that on a quarter-by-quarter basis, we're only sampling 1 or 2 loans from you. These designations can change. We do have some sellers who go between categories for a quarter, quarter to quarter, but it is rare. Generally speaking, your history is a good indicator of where you will be in the future, whether you'll be small or large for terms of our fee calculation eligibility. So if you are large, let's talk through the fee. So the fee is equal to the fee rate times that fee eligible UPB. So we'll go through step by step here, starting with the fee rate. Fee rate is based on a seller's NAQ rate, and our larger sellers should be familiar with their NAQ rates. So if we take a look at that table at the bottom, looking at those green columns, different NAQ rates correspond to different fee rates, and that goes in a step-up fashion. So if you have a NAQ rate between 0 and 2%, so under 2%, you will have no fee under this program, regardless of your size. From there on up, it escalates. So if your NAQ is between 2 and 5%, you have a quarter basis point fee or 0.000025. Those zeros are important. Next step from 5 to 8, you can see it's 0.75 basis points, and it goes up from there. One more category from 8 to 10, and then finally from 10 and up for the NAQ rate. So once we have that fee rate, the next step is the fee eligible UPB. So that is simply the total volume, the total UPB of loans delivered to Freddie Mac in that quarter. Less a small number of exclusions. Some of our sellers will have FHA or VA loans. Those kind of loans are taken out of the total. But by and large, if you need to estimate this, it's good to take the total volume of loans you sell to Freddie Mac in the quarter and determine the UPB for those loans. So then we very simply multiply those numbers together. So to give an example, if a seller has an NAQ rate of 3.5% and they deliver $250 million to Freddie Mac in that quarter, that 3.5% NAQ rate corresponds to that quarter basis point fee or 0.000025. Multiplying that against the delivery of $250 million gives us a total aggregate fee for the whole quarter, so covering all loans, of $6.25 thousand for that quarter. So 3 quick points before we go forward. First things first, as I mentioned, that fee is for the whole quarter, right? So it's not a per loan basis. It's not anything individual, and it's just once for the whole quarter in aggregate. And each quarter has no bearing on the following quarter. So Freddie Mac QC can lag. Let's use an example of Q1 for next year. We are likely to complete the QC on Q1, probably sometime in late summer of next year. But once we do so, we will go back to Q1 and say, okay, the NAQ rate was for that quarter. What was UPB delivered for that quarter? And multiply those 2 numbers together. It's a total reset for the following quarter. Q1 has no bearing on Q2, either in terms of the NAQ rate or the UPB delivery. The second point is that we just use our PL base sample to calculate the NAQ rate, but all performing loans are eligible for this program. So what this means is that, let's say we have a different performing loan, like a targeted sample or a self-report, you will still get the benefits of this program for those loans. So it's very important that as you go through and make sure that this makes financial sense for you, that you're bearing in that you'll be, you won't have to repurchase any loans in those other performing categories as well, not just the base sample. And the final point is that, like I mentioned, that UPB is the total UPB delivered to Freddie Mac for that quarter. It's not just the sample loans or just the base sample. It is the total UPB of all loans delivered to Freddie Mac.
So Jarrell, I have a question for you. If a seller was in one NAQ band in Q1 and they worked really hard and they wanted to improve their NAQ in Q2, if they had a fee in Q1, there's a high likelihood that if they were able to work hard and get their NAQ under 2%, that they'd have absolutely no fee. Is that correct? That fee can change quarter over quarter?
Yep, absolutely. So it's not like you have an NAQ historically and you're locked into that. Each quarter is independent. So if you have a higher NAQ in one quarter, but then much lower the next quarter, your fee will go down or be non-existent. Obviously, our intent here is we want nobody to pay any fees, right? We want perfect quality across the board. So ideally, everybody's in that 0 to 2% category. But if seller does have a worse NAQ for one quarter for whatever reason, that's just a one quarter situation. We can always go through and work with that seller through other programs as well. But ideally, that NAQ goes back down and the seller is in a lower category for the following quarter.
Thanks, Jarrell.
Yep, no problem. All right, next slide, please. So as I mentioned earlier, most performing loans are eligible for this program, but there are still some defects which are in excluded categories. So what this means is that if we find a defect that meets these criteria, this loan will still go to repurchase. We've been running this pilot for about a year. The overwhelming majority of our loans are included in this program. So we do expect most performing loan defects to be eligible. But anything in this category will be excluded still. Full details are in the TOB. So what you see here is a summary, but if you want specific references to certain chapters or sections in the guide, the TOB does lay that out at a more detailed level. But I'll still go through these quickly piece by piece. So the first defect category is any loan that violates Freddie Mac's life of loan reps and warrants. This generally is things like charter violations, compliance violations, cases of fraud. The second category is loans that don't comply with Freddie Mac's E-list. Next are certain unacceptable appraisal practices, specifically those as they relate to discriminatory language. So we're not talking about using bad comps or anything in the appraisals here. We're talking specifically about discriminatory language in the appraisal. Next is any loan with severe property quality or condition issues. So things that are or should be classified as Q6, C5, or C6. Then certain ineligible condo and co-op projects. And then finally, any loan that was sold to Freddie Mac with recourse, where the recourse is still in effect. So this program applies to all origination defects. So that does mean that servicing defects and non-performing loans will still follow the traditional path. The last point to make here is that participation in this program does not in any way alter the rep and warrant framework. If a loan has a clean payment history for 36 months, it will still get that payment relief, per the rep and warrant framework. But any loan that does not perform can still go to repurchase if that defect is severe enough to be called into our NPL sampling. So I know we covered a lot of detail there real quick. We will have more time for questions at the end, but I'll kick it back over to Gwen and talk about how we opt into this program.
Thanks, Jarrell. Let's go to the next slide, please. So as I mentioned at the beginning of this talk today, all sellers are eligible to participate in the pilot. And the pilot is governed by a term of business or a TOB. And this TOB has no end date, meaning you don't have to continually recontract to get into the term of business. However, the flip side of that, a seller may opt out, and I'll walk through that in just a minute. For most of our sellers, the way to opt in is to send an email to a designated opt-in mailbox. And the email address is shown on this slide. The email must contain the information provided in the opt-in template. If you fail to include all of the requested information, that will result in a delay and you may miss the opt-in time period for that quarter. There is a link to the sample term of business. We'll be providing that in the chat. And also it's linked on the QC webpage on FreddieMac.com. This recording will also be on that webpage. Larger sellers with statistically significant NAQ rates have a slightly different path, and they should reach out to their account executive. I just want to reiterate, this isn't a get out of jail free card. Loan quality is still really important. So after joining the pilot, we're still going to be monitoring seller quality to govern continued participation in the program. So let's take a look at some of the participation deadlines. I'm sure you're anxious and want to know when do you need to opt in to be in for the first quarter. Can we go to the next slide, please? So to participate in Q1, you're going to need to put your request in by December 20th, unless you've been notified otherwise. For sellers who choose to participate later, the opt-in period is quarterly, and the deadline is no less than 15 days prior to that quarter. For example, the Q2 opt-in deadline is March 15th, and that would be effective for loans delivered on or after April 1st. Now, I did mention in the previous slide that sellers have the ability to opt out. The opt-in timelines are effective at the end of the calendar year. So we do ask that you be in for 2 quarters. So for most people, you would be, depending on when you opted in, you'd be able to opt out at the end of that calendar year. But if you were to join in the 4th quarter of a calendar year, rather than opting out in that year, you would opt out at the following year because you need to have 2 quarters. Let's turn this over to Jarrell for some key considerations to keep in mind. Next slide.
Thanks, Gwen. Next slide, yep. So a few last points to cover before we get into some of the seller questions we have. So first things first is a transfer of service can create some particular situations. My ask is always, if you have a very specific question, to please reach out to your Freddie Mac representative to walk through how transfer of service could impact this program. But broadly speaking, there are 2 things to remember when it comes to transfer of service. One is the seller who sold the loan to Freddie Mac, and the second is the seller who currently holds the selling rep and warrant, the selling rep and warrant rights. So in general, and with the exception of programs like operational bifurcation, such as Core Advantage or EZD, the seller who sells the loan to Freddie Mac is the one who's responsible for both the NAQ rate and ultimately any fees under this program. When it comes, though, to the selling rep and warrant, so the actual remedy letter, so if we find a defect, that will go to whoever holds a selling rep and warrant. So to use an example, if one seller, if a seller is in the pilot and they sell the loan to Freddie Mac, but then they transfer the loan to a seller who's out of the pilot before Freddie Mac does our QC, that out of the pilot seller will be the one who actually receives the letter. Now, because that seller is not in the pilot, that seller will receive the non-pilot letter, so a traditional repurchase or other alternative. So a couple things to bear in mind as you do transfers of service. If you have questions around your rep and warrant holder, you can always check in Loan Coverage Advisor. But like I said, for any other key questions, please contact a Freddie Mac rep if you have a question about a specific transfer of service scenario. The second consideration is that this pilot will replace existing repurchase alternatives for participating sellers. So earlier this year at the MBA, we announced a few programs. We announced the expansion of this pilot. We also announced a new fee-only repurchase alternative, plus some changes to our current recourse fee as well. So consider it to be 2 paths. If you opt into this pilot, this will be the path for you. No matter what, anytime you get a defect, it will be handled under the terms of this pilot. If you do not opt into this pilot, you will default to using our other path, which includes both, the recourse fee and fee-only options. Those are mutually exclusive. So once you're in the pilot, you no longer have access to the other paths, to that other path. Another point too is that this program, the effective date, is always based on the loan settlement date. So if you opt in for Q1, we are still buying loans today, obviously. The QC on those loans can lag. Odds are any loan that we buy in December, you'll probably not get results on until sometime, mid Q1, maybe even into Q2. Even though the QC is being completed in Q2 for those loans, if your opt-in date was for Q1, because those loans were purchased in Q4, they will still be subject to the old path. So it's not until the post-effective date settlement date. So if it's Q1, any loan that we buy in Q1 will be subject to this program. So that's the bulk of our presentation here. I know we probably got some questions through, so I'll kick it back over to Chris to read out some questions we got in the chat.
Thank you both. Yes, quite a few questions coming in. We'll kick it off with, how do I tell if I'm a seller in a statistically significant sampling population? Will I have the option to change my opt-in if I switch between categories?
No, thanks, Chris. So first things first is, once you opt in, you have opted in for the terms of that opt-in, as Gwen mentioned, kind of given those timelines about opt-out earlier in the presentation. But generally speaking, your best way to tell whether you are statistically significant or not is to look at your history. If you go into eco, most sellers who are in the small category, they will have been sampled 1 or 2 loans per quarter. Generally speaking, sellers who are in that more statistical category, they're selling us hundreds of loans a quarter. We're sampling them. Anytime you're above 3 samples, it's probably worth asking your AE, what category am I in? But, generally it gets up to a much higher number of samples before somebody's in that statistically significant category. So like I said, history is your best indicator. We can't promise that you won't switch between quarters. Like I said, it does happen, but it's a couple sellers per quarter who that affects. Primarily speaking, if you've always been small, you'll likely still stay small. If you've always been large, probably the same. But if you're on that cusp and have questions, please reach out to your AE.
Thank you. The next one is, does payment of this fee give me insurance on a defective loan? What happens if that loan retained by Freddie Mac later goes NPL?
Got it. Thanks, Chris. So this payment is not insurance on a particular loan. That payment is supposed to be for the whole, basically, quarter of loans sold at Freddie Mac. So what that means is that, if you're large enough that our sampling generates a statistically representative sample for you, we are charging that fee based on our sampling as a proxy for the overall quality of loans in that vintage that you sold us. So in other words, we will pay the fee, but that has no bearing on, whether those loans are eligible for repurchase at some point later on if they go NPL. Because if those loans do stop performing prior to the rep and warrant sunset, they still may be subject to repurchase. Generally speaking, the rep and warrant framework does define a performing loan, so the inverse would be a non-performing loan. But a defect generally has to be more severe for us to call it into our NPL sample. It's generally not a shorter delinquency, but once a defect gets severe and our delinquency gets severe enough, it may be called back in for repurchase, so long as it has not crossed that 36-month rep and warrant sunset period.
Excellent. What percentage of performing loan defects were eligible for this pilot?
Got it. So for this, we can't necessarily give a specific percentage because it does change by seller. Each seller has different types of loans they sell. Some specialize in one area versus the other. But generally speaking, like I mentioned earlier, it was a very high hit rate. The overwhelming majority of performing loan defects were eligible for this program. Our exclusions tended to be more severe and kind of smaller categories.
Okay, and then how is the statistically significant sampling rate calculated?
Yeah, so, like I mentioned, it is internal to Freddie Mac. It is primarily based on our recent volume and quality. So in other words, if you sell more loans, it tends to be if you sell more loans at Freddie Mac, there's a higher likelihood that you'll be in that statistically significant category. If your quality starts to decrease, so if you have worse quality, same thing, we might need to sample more. So it could drive up that rate. One thing I do want to mention is kind of what the numbers that we're talking about look like, right? So I know some sellers, and if they're kind of on the cusp, they're selling, somewhere in the ballpark of $100 million to Freddie Mac in a quarter. I know a lot of those sellers are concerned about not knowing whether or not they'll be in that kind of small or large category. The big thing I want to emphasize is if we go back at some point, if you take a look later on at that table we talked about in that fee section, a seller right on that cusp who's delivering about 100 million in UPB for a quarter, a NAQ rate between 2 to 5% is only $2.5 thousand in fees for the entire quarter. That a higher rate, 5 to 8%, is it's 7.5, right? So things to consider is just that if you are on that cusp, the fee amounts still probably make economic sense for you. We would obviously encourage all sellers to do their own math, but take a look at kind of the overall impact. If you have a recourse fee or a fee only on just one defective loan, that can very easily make this program cost effective for you because the odds are it's the same price, right, or even less so. So definitely take a look. We think this program makes a lot of economic sense, especially for those smaller sellers. But please take a look, do the math yourself. We like our program, we're happy with our program, but we want you to take a look and decide for yourselves.
Thank you. And we have a few about self-reporting. If a loan is self-reported outside the performing sample, say a lender identified defect in post-close audit, does that loan get the benefit of this repurchase alternative process?
So yes, it does. Any performing loan will have this benefit regardless of the source of that defect. So like I said, it's just the PL base sample which drives the NAQ rate, but all performing loans have the benefit. So this should hopefully encourage sellers to report these loans back to Freddie Mac if you get something, or if we have a targeted sample later on, that will not affect your fee. And these programs those loans will still receive the benefits of this program. So if that defect is in one of our included categories, then we will retain that loan.
Right. And then do loans self-reported by the lender through a lender QC process impact the NAQ?
So no, the only thing touching the NAQ will be our RPL-based sample.
Excellent. Okay. And then a few more. This is for loans that are performing. What if a loan becomes delinquent after the QC quarter?
So in that case, it will depend on, where, basically a couple of things. One is the severity of the delinquency, and the second is kind of where we are in the rep and warrant sunset period. So any loan that has a clean payment history for 36 months will get rep and warrant relief for the payment portion of this. So if it goes delinquent after that period, Freddie Mac will still retain that loan. If the loan goes delinquent prior to that 36-month rep and warrant sunset, it does depend on the severity of the delinquency. So, the terms of performing are defined in the rep and warrant framework, but generally speaking, Freddie Mac will not include a loan in its NPL sample unless that delinquency gets more severe. So right now we're looking at about a D90 will trigger our NPL sample, but that can change over time. So it's one thing we want to emphasize is that, we can't necessarily commit to a specific delinquency, but generally speaking, it takes a more severe delinquency for us to call it in with our sample. And if we do call it in and that loan has been previously found to have a defect, that loan will go to repurchase.
Thank you. Okay, I think we have time for about 3 more. How is a performing loan defined?
Got it. So performing loans for our program are, any loan that with basically the clean payment history per Freddie Mac's, rather per the Rep and Warren framework. So it's any performing loan sample, which basically for us just means any sample that's not our NPL sample. So we have performing loan base sample, performing loan targeted samples, some component reviews. We have any sort of performing loan self-report. So anything that enters our QC system with a performing loan status will be considered a performing loan for the terms of our program.
Excellent. And do we need to reapply each quarter to opt in?
I can take that one. No, you don't. This term of business does not have an expiration date. As I previously said, you can opt out, but you do not have to continue to opt in.
Thank you. And last one, if you opt to pay the fee instead of repurchase, do you pay the quarterly fee one time or each quarter till the loan is paid off?
Yep. So it is a one-time fee. So the fee is not per loan. We will go through to use Q1 as an example. We buy those loans in Q1. We probably wrap up your QC for Q1 sometime in late summer. We'd go back. We'd say, okay, this was your total NAQ for Q1. This was your total UPB for Q1. We multiply those together, come up with a fee. That fee is leveraged on the next ACH sweep. And then we totally close the book on, that quarter. It's a totally blank slate for Q2. So it's a one-time fee for each quarter. It's not per loan. It's for the entire volume of loans delivered in that quarter.
And as we previously indicated, as the NAQ goes down, you get a fresh slate every quarter, so you can get down to that 0 fee if you're in that fee category.
Excellent. Thank you both. I think we can move on to the next slide to close out the session. As a reminder, for additional information, we encourage you to take advantage of the training and resources available from the Freddie Mac Learning Center, and the Customer Call Center provides seller service support Monday through Friday at 1-800-FREDDIE. Additionally, check out the Freddie Mac QC webpage for more information on the Performing Loan Repurchase Remedy Program. A link to the site will be in the session chat for your use and will also be attached to the email promotion of this recording. And please visit the Freddie Mac Single Family website at sf.freddiemac.com and stay current with resources there, including the Single Family Seller Servicer Guide at guide.freddiemac.com. Thank you so much for attending our session, and thank you to our speakers for this presentation.